as Jonathan said, I work here at the Minneapolis Fed, but the views I'll express are my own views. Okay. So how should we conduct monetary policy in light of the varied individual circumstances of households in the economy? I think we can divide that question into two halves. The first half would be, how does this heterogeneity affect the goals that monetary policy is trying to achieve? And in Josh's talk yesterday, he kind of was pushing at that point. Another part of that question is, how does this heterogeneity affect the way the economy works? And that's what I'm going to focus on today. Understanding how the economy works is important because it allows us to more appropriately interpret the incoming data and also have better assessments of the likely consequences of policies we're considering. Okay? Traditionally, macroeconomics made use of a sort of convenient assumption that the economy was populated by a representative household. In recent years, people have sort of tried to relax that assumption in the context of an economy that also has a role for monetary policy. This is the so-called heterogeneous agent New Keynesian literature. Okay. Most of that literature has focused on the implications for non-durable consumption. Today, I'm going to tell you about a research project that looks at the implications for durable consumption. Okay? So the work that I'll talk about today is joint work with Johannes Wieland from UC San Diego. Okay, so when I say durable goods, think cars, washing machines, furnitures, and if we take a broader perspective, include residential investment in that. Okay? So we think these are, on average, not a huge share of consumption, maybe 20%, but they're very important for the monetary transmission mechanism. By one measure, they account for 2/3 of the effect of monetary policy on aggregate consumption. And so that's part of our reason for focusing on this component of consumption. Okay, so when you look at the micro data on durable goods consumption, an inescapable feature of the data is that purchases are lumpy. Okay, so you buy a car every few years, not every quarter. Okay, so the standard way that economists would think about this is in terms of some kind of fixed cost. So in this figure, imagine you have the value of the car, you buy a new car, it depreciates down to some threshold where you decide to adjust and get a new car, and it depreciates down and you adjust again. And so in this period, you're not making any adjustment to your car because there's some cost of going to the dealership, finding the car. There's also some cost of selling your used car for probably less than you could buy a new car for. Okay. So in this world, I'm going to make an argument that monetary policy works rather differently from the way we usually think about the effects of monetary policy on consumption. So now let's take this sort of world and take a snapshot in time where there are households with different levels of the value of their durable stock. Okay? So on this figure, here we have the value of their durable holdings on the horizontal axis, and here we're plotting some distribution, that's the shaded area, how households are distributed over their durable holdings. And this is a very sort of stylized view of the world where people just smoothly depreciate their durables, and the people with the lowest value of the durables are going to say, adjust this quarter, buy a new car this quarter. The people who have a little bit more valuable stock are going to let their stock depreciate a little bit more, and then next quarter they're going to buy a new car. Okay? So this red line sort of is the threshold at which you're indifferent between buying the car this quarter or next quarter. Okay? So what a monetary policy stimulus will do is it's going to shift that threshold. So if we cut the current interest rate, we're going to reduce the opportunity cost of owning the durables because you get less interest on your bank account. So you're going to be more willing to buy the durables, and this threshold will shift to the right. Okay? So this shaded area are sort of the mass of people who are now going to adjust this quarter as opposed to next quarter. So the first point that I'd like you to really notice is that in this figure, when you make this stimulus, you've now reduced the mass of people who are going to be ready to buy a car next quarter. So there's some sort of drag on demand going forward. Okay. The next point is that when you're making this decision about do you adjust today or next quarter, you're really thinking about a short-term decision. 2 quarters from now, you're going to buy the new car. You're going to own the new car, either way. So what interest rate is most relevant for your decision of whether or not you adjust this quarter or next quarter is the short rate. Okay? The third point that I'd like you to notice is that if there's some shock, some recession hits, some people fear unemployment, or there's some decline in income expectations, people are going to want to hold a lower value of durables. They have to reduce their consumption on all fronts, say. So then these thresholds shift to the left. And in general, there's going to be less mass over here because many of these people may have already adjusted. And so the same stimulus that shifts the threshold by the same amount is going to induce a smaller fraction of people to buy a new car. So this shaded area here is smaller than this shaded area here. So when a recession hits, say, monetary stimulus is going to be less effective for this reason. Okay, so let me provide a little bit of context for this discussion by showing you the most basic textbook model of consumption and monetary economics. So here we have the output gap, the interest rate as a deviation from its normal level, and the expected future output gap. And here sigma is a parameter that controls the sensitivity of the economy to interest rates. So the first thing we can observe from this equation, so this is sort of like the textbook model, if you will. The first thing we can observe is that it's purely forward-looking. So the history of interest rates is irrelevant in this simple model. Okay? So there's that sort of current stimulus creates a drag on future demand, doesn't show up here. The second thing that we can observe is if we solve this equation forward, we see that the current output gap is the sum of future interest rate deviations. So there's a perfect substitution between cutting current interest rates and cutting future interest rates. This is part of the sort of feature of these models that gives rise to this forward guidance puzzle literature. And then the last point we can observe is that all interest rate cuts stimulate the economy by this constant amount, 1 over sigma. So in our project, we emphasize a different form of the monetary transmission mechanism, which is that it accelerates adjustments. Okay? And the three observations from the simple model that I just mentioned are overturned. So here, stimulating today leaves fewer people to adjust next period, so the history of rates matters. The marginal household is sort of thinking about buying today versus tomorrow, so current rates stimulate more than future rates. And then the effects of policy depend on how many households are near the adjustment threshold, which I'll show you leads in the model to demand to be less sensitive to interest rates in recessions. Okay. So this project kind of speaks to discussions of policy space. Okay, so when I say policy space, I mean the notion that a central bank might keep interest rates high so that it will be able to cut them in the future if demand deteriorates in the future. So the key sort of feature of our model is that with durables, stimulus shifts demand from the future. So if we're worried that something bad might happen in the future, there might be some reason not to shift the demand from the future to today. Okay? So you want to preserve the policy space. Furthermore, because forward guidance is less powerful in this model, the central bank is operating with less ability to stimulate the economy to start with. And moreover, because in a recession, stimulus is going to be less effective, this policy space is already further reduced. Okay. So in this talk today, I'm going to sort of show you results from our paper. I'm going to give you this one-slide verbal description of what goes into the model and then just show you some results. Okay. So in the model, we have households who are heterogeneous in their labor income, their financial assets or debt, their durable holdings. They consume non-durables and they enjoy a service flow from owning durables. Okay? Their durable holdings are subject to a fixed cost. So you have to pay a fraction of your durables when you adjust them. They undergo depreciation and the households have to pay maintenance costs. Their operating costs, so think if you own a house, you have to pay some property taxes. If you own a car, you have to buy gas for it. And then a last ingredient is taste shocks. So what taste shocks do is they make people sort of want to adjust for reasons that are a little bit unrelated to depreciation or income fluctuation. So you get a job offer in a distant city, you're going to move houses even if you're perfectly happy with your house. Or maybe you have a kid and you want to buy a bigger car. It's sort of something that's outside the model that makes you want to adjust durables. The crucial thing that this brings to the table is it makes durable purchases a little bit less sensitive to interest rates, which aligns well with the data. Okay. Then in terms of the rest of the model, we're going to have sticky wages in the model, which give rise to a Phillips curve, and monetary policy will follow an interest rate rule. Okay. So in this slide, I'm showing you the effect on output. So this is a % deviation of output from its normal level in response to 3 different paths for the real interest rate. The blue line, the central bank cuts the real interest rate by 1 percentage point right now. The green line cuts by 1 percentage point a year from now, and the red line cuts by 1 percentage point 2 years from now. What I'd like you to notice is that right here at date 0, the effect of cutting current rates is much larger than the effect of cutting future rates. Okay, so this goes against the notion that future monetary policy stimulus is just as effective as current stimulus. Putting that same idea in a sort of different way, here I consider 3 different policy paths that all accumulate to the same promised deviation of interest rates. So the blue line cuts by 2% for 2 quarters, the red line is 1% for 4 quarters, and the green is 0.5% for 8 quarters. So again, these promise the same cumulative deviation of real interest rates, and in the textbook model would lead to the same output effect on impact. But again, we see that the sort of front-loaded stimulus is quite a bit more effective than the more low-for-longer policy. Okay, so these slides are meant to convey that forward guidance works less effectively in this view of the world than it does in the sort of textbook model. Okay. So I'll use the following calculation to sort of summarize how much policy space there is. Okay? So how much can the central bank raise output by using all of its ammunition, if you will, right now? So how much ammunition does it have? This is just sort of rough calculation, but they can cut by 2.5 percentage points, and they can promise to keep it at 0, if you will, for 4 quarters. Okay, so that's just the experiment. So in this model, that raises output by 6 percentage points today. Okay? In the sort of textbook model, that would lead to an 8% increase. The difference is that in the durables model, this promised future stimulus is less powerful. Okay. Now let me show you some results that illustrate the fact that the history of rates matters. Okay? So here, the green lines show 2 different paths for the real interest rate. Okay, so the dashed line cuts by 1 percentage point at date 0 and holds it low for 2 quarters. The solid line keeps the interest rate low for 2 previous quarters. Okay. Now, crucially, from date 0 onwards, they follow the same trajectory. Okay, so if history were irrelevant, we would expect the same output dynamics from date 0 going forward. But what you can see is that the initial impact of the stimulus is sort of larger and then peters out, because on impact, you're shifting that threshold to the right, but then in subsequent quarters, you've sort of already accelerated some of the purchases that would have normally occurred. So from the perspective of date 0, the case where you've waited to cut interest rates has a more powerful effect than the case where you were previously stimulating the economy. Okay, so in terms of our sort of summary calculation, if we do the same stimulus, go down by 2.5 percentage points for 4 quarters, but we had already done that stimulus for 4 previous quarters, now instead of raising the output gap by 6%, we raise it by 3.7%. Okay. The next set of experiments that I'll show you consider sort of a stylized recession, and the point that I'll make is that policy is less powerful in this recession. And so the recession that I'm going to generate comes from a drop in income. So we're going to have a once and for all drop in TFP that leads to a 4.5% decline in permanent income. Okay, so this is roughly modeled on the decline in income in the Great Recession. So here, focus on the blue line first. So when the recession hits, people want to have fewer durables going forward. They have less income, they want to sort of downsize their car, their house, and so on. And they have inherited a lot of durables from the past, so for a period of time, they're going to refrain from buying new durables and let their durable stock depreciate down towards their new target level. So on impact, we have a pretty sizable output gap because people stop buying durables. Okay, so this is sort of the output gap relative to the new steady state level of output. The blue line, the central bank does nothing. Real interest rates remain constant. Okay? The green line promises this 2.5 percentage point cut for 4 quarters. And so there's a substantial, stabilization of the economy. But now consider if the central bank had already stimulated the economy. And it makes the same promise at this point, but it had already been stimulating the economy. Now we get the pink line here. So the recession is about 1 percentage point deeper because we've already used up some of our power. This slide takes that previous slide and just takes differences between those lines to show you sort of the effect of the policy stimulus. Okay? So in normal times, if we promise this 2.5 percentage point for 4 quarters stimulus, we raise the output gap by 6 percentage points. When the recession hits, the economy is less sensitive to stimulus, and that same policy only raises the output gap by 3 percentage points. If we have a recession plus previous stimulus, we only get about 2.5 percentage points. Okay, and so both of these effects come from the fact that people have already accelerated their durables in the durable purchases in the past, and there are now fewer people sort of on the margin of adjusting. Okay. So sort of to summarize now, so in the textbook model, we had 8 percentage points of policy space. In this durables model, we had 6 percentage points in normal times. If we had stimulated the economy previously, we had 3.7 percentage points. If a recession hits and we hadn't stimulated the economy previously, we have 3.1%. And if we had a recession and previous limits, we get down to 1.6%. Okay, so comparing, say, these numbers would say there is some benefit to maybe thinking about preserving policy space. Of course, you have to balance that against the costs of deviating from what you might have thought to be optimal in the previous period, but this is sort of would be the benefit of the calculation. Okay. One of the last things I'll show you is that there is some evidence in the literature for these sort of policy reversals or intertemporal shifting of durable purchases. So this is from a paper by Marianne and Sufi who look at the cash for clunkers policy. And what they do in their research design is look at cities that were sort of more exposed to the policy because they have more clunkers and cities that are less exposed. And so this blue line here shows the auto purchases in the more exposed cities compared to the auto purchases in the less exposed cities. And here's the policy implementation. And the key thing to note is that, yes, there's a boom in purchases in the exposed cities, but then it lags behind afterwards. And so in terms of the cumulative effect, after a few months, there's sort of no accumulative effect. Okay? And so this really coincides with the workings of this lumpy durables model that you can accelerate purchases by giving some incentive for people to accelerate their purchases, but after a while, you're back where you started. Okay. So to wrap up, so here are some of the sort of takeaways from this research project. So in this world where heterogeneous households are making decisions about when to time their durable purchases, a key monetary policy transmission mechanism is to shift the timing of those purchases. And because that's an intertemporal shifting of demand as opposed to sort of creating demand from out of nothing, then that sort of justifies these concerns over policy space. And it also points to a particular risk management strategy, which is rather different from the way central banks often think about risk management. The typical view of risk management is to get ahead of the bad thing. This view, the view that would sort of emerge from this analysis, would be to hold off if you think something bad is going to happen, to stimulate when it happens. And then sort of more broadly, this research agenda would point to the fact that the effects of policy, of monetary stimulus, depend differently on how the households are sort of arranged relative to being ready to buy some durable good. And so monitoring the balance sheets of households, their income expectations, and so on, are potentially an important ingredient to understanding the likely effects of policy. Okay, thanks very much.
So yeah, thank you very much for having me. This research is motivated by the observation that the dollar is a unit of account for many nominal debt contracts in the economy. And that means that when we have inflation, it lowers the real value of the dollar, or its purchasing power, and therefore also the real value of lots of nominal promises that people have made. So this has wealth effects that are good for borrowers and bad for lenders. And I find it helpful to distinguish two types of these revaluation shocks that we could have. One is just surprise inflation, which leads to a similar drop in the real value of all promises, regardless of their duration. So if there's just an unanticipated increase in the price level, every dollar now has a purchasing power of 99 cents, then just all promises are worth 1% less. The other type of shock is surprising news about future inflation. For example, the central bank might announce a higher inflation target. This then leads to a smaller percentage drop in promises that have relatively shorter duration, because promises with short duration are not affected by inflation in the far future, after the promise has come due. So what I'm going to do in this talk is I'm going to first talk about a measurement framework for nominal positions and their exposure to these different types of revaluation shocks that could come because of inflation. And this is an update of some work I did a couple of years ago, in fact, when I was working here at the Minneapolis Fed with Matthias Döbke. And then I'll talk about the aggregate and welfare effects of these revaluation shocks in a model with heterogeneous households that draws on some recent work with Veronica Selesneva. Okay, so measurement. We like to determine the net nominal position of sectors or individual households. By that we mean the difference between nominal assets and nominal liabilities. And so the sectors we'll consider here are households and the government and the rest of the world. And this means we're going to consolidate sectors that are owned by these, in particular businesses and financial intermediaries. So the net nominal position is going to contain not only nominal assets held directly, but also those held indirectly, for example, through mutual funds or through defined contribution pension funds that the households have control over. It also contains nominal debt that's owed indirectly through the ownership of equity. And so the data comes from the flow of funds accounts for sectoral positions and from the Survey of Consumer Finances for more detailed distribution of households. And the main work that we went into this was to construct payment streams for all of the nominal instruments that allows us to restate the positions at market value and also measure the duration of each position, which is important for thinking about these revaluation exercises where the duration of the promises matters. So let me show you some pictures. This is the net nominal position of the government sector in the US in the post-war period. And so this is consolidated, so it's treasury debt less bonds held by the Fed, less what's in government-sponsored retirement accounts, so, and then that's negative altogether there. And that was high right after the war, and is high again today. Between World War II and 1980, this was basically held by households, and it was gradually reduced over time. And what changed in 1980 was that the increase that came in the government debt was funded partially through holding by households, but also through holdings by the rest of the world. That's the pink line. With a strong acceleration in the housing boom. And then what has happened since then is that the position of the rest of the world has remained relatively similar. And the further increase in the net government debt position has been funded by domestic holdings by households. Okay, so let me make 2 more comments on this household net nominal position, this blue line. The first is about the role of indirect debt. So when I leave out from this the indirect debt that households have through their ownership of businesses, I get this green line. So that is just direct bond holdings plus holdings through mutual funds and pension funds. Okay? And so that is higher, and it even more dramatically increases after the financial crisis. The people holding a lot of bonds directly. And that also means that the difference, this red area, that is the indirect debt that shareholders owe through their ownership of equity. That is something that's sizable and that changed over time and has increased recently. So that's the first comment. The second one is about the gross position. So far I've just talked about net positions by sector, but that masks the fact that there are borrowers and lenders within each sector. For example, for households, if you plot nominal assets in green and nominal debt in blue, then you get 2 strongly increasing lines that show that overall credit market activity has always been growing and has only slightly decreased after the financial crisis. Okay, so now let's talk about revaluation. So to get some action, let's do an inflation episode that's sizable, 5% for 10 years. Okay? And I want to do 2 thought experiments. One is the surprise inflation. So a one-time unanticipated increase in the price level so that we get this effect of a same percentage drop in real values for all positions. Now, so that's basically saying all of this 5% more inflation for 10 years comes at the same time. That's not something that we might likely see, but it's useful as an upper bound. So, because if you had sort of several repeated surprises, this is sort of the most that could happen. The other thought experiment is surprising news about future inflation. That basically says there is an announcement today where the Fed says we're going to raise the inflation target by 5% for 10 years. And that's going to get us this smaller percentage drop in promises with short duration, and we can think of this as a lower bound. To see this in terms of numbers, here I show the losses on 0 coupon bonds. So those are promises that pay off at exactly one date. By maturity, this is the date when it pays. So this is in years on the horizontal axis, and the real loss in percent on the vertical axis. If there is the full surprise, so all of the inflation comes at the same time, then this just devalues everything by 40%. So that's the upper bound. In contrast, if we make this announcement today of 5% more inflation for 10 years, then we get sort of for the first year it gets hit by 5%, the second by 10%, and so forth. And then all positions 10 years or longer are going to be also hit by 40%. Okay, so now let's ask, what are the gains and losses on these gross household positions when this inflation episode hits? And so I'm going to compute hypothetical gains and losses for each of the dates for which I computed positions before. And so the first is the surprise scenario, surprise experiment. And that looks, in terms of the pattern, just the same as the position itself, because it's just the position multiplied by 40%, the losses that are applied to each promise. Okay. And basically, the losses are always larger than the gains because the household sector is a net lender. Now, let's contrast that to what happens when we have news about future inflation. These are the dashed lines. And so here, these are going to be smaller because the short positions are devalued less. Okay? So there's this overall scale difference. But the other thing that comes out is that recently, the blue line, the gains, has risen above the green line, the losses. Okay? And so once you take into account this duration, and you introduce an experiment where long duration assets are revalued more, then that is something that on net helps the household sector as opposed to hurts it. So to sum up, for these hypothetical gains and losses, when we have surprise inflation, then the gains to the households are smaller than the losses because the households are net lenders. But when there is surprising news, then the gains are larger than the losses recently, for the recent years. Because basically, so in a nutshell, that the households lend short and borrow long. So they do the opposite of what the banks do in the economy. Okay, so now let's think more about who these households are. So far this was just about there's some positive position, negative positions. Who are these people? Okay. So for this, I'm going to turn to the survey of consumer finances, and I'm going to show you net gains by groups of households in the survey of consumer finances for the year 2013. Okay, so it's for a particular year. And I'm only going to consider the news scenario. So I'm going to ask, what if higher inflation target was announced in 2013? And I'm going to slice the household sector by age as well as by net worth. I'm going to, for the picture, I'm going to call the rich the top 10% by net worth, and the poor will be the bottom 20%, and then the middle class is the rest. And the main pattern that comes out is that this redistribution goes from relatively old rich people to young middle class. So that, and so here's what this looks like. When we study these net gains by group of households, here I have the age at the date of the policy announcement, so 2013, on the horizontal axis, and then the gains or losses by cohort on the vertical axis. And so you basically see that the rich, who are in blue, who are relatively old, they all make losses. So for cohorts are kind of in two-year bins. And so for all of these make sizable losses. And the young and middle-aged middle class who have a lot of mortgage debt, those are the big winners. Okay. So now that is just wealth distribution after an announcement. Okay? So now then people are going to do something about it, and we're going to ask how do people respond. And so now we're going to want to study the aggregate and the welfare effects of this in a model. So I'm going to give you the sketch of the model, and then I'm going to show you some numbers what comes out. So this is a small open economy. There's no aggregate uncertainty. And households care about leisure, about housing services, and about other consumption, which is the numeraire. The housing comes in indivisible units that differ by the service flow they provide. And the baseline is that there's a fixed distribution of housing units. So that would be the case where everything has been parceled and that's fixed. We also study the case with construction. In any case, there are going to be competitive markets for both service flows, so rent, and houses or house prices. And then all other assets are lumped together into borrowing and lending at the world interest rate. Importantly, households face a collateral constraint. So the borrowing is constrained by the house value times some maximal LTV ratio. We've got overlapping generations of households. They differ in preferences. Both they can differ in the discount factors as well as in the preferences for housing tenure. Some people like to rent more than others. And they differ in skills. There's both permanent differences and sort of ongoing shocks to how well they can earn money. And then there are warm glow bequests. So people want to leave some money at the end. The rest of the economy, apart from the household sector, consists of competitive constant returns firms that produce numeraire from capital and labor. And the government runs an income tax and spends things on government services and runs a social security system. Okay. So those are sort of fairly standard features that a lot of models in the literature have. We have what's sort of different from much recent work is the sort of the modeling of the housing sector, which we think is particularly important when we talk about mortgage redistribution. So we're going to calibrate this to both aggregate data and the Survey of Consumer Finances data for 2013, basically matching income and portfolios by age and net worth. So we're going to calibrate the steady state of the model to this. And then we're going to look at a revaluation shock, which is exactly this unanticipated increase in the inflation target. So we're going to use this, this number, 5% for 10 years, that I introduced before. And I already showed you, for some groups, these real wealth transfers by group of households. So we calculate those using the positions that we measured, as well as the gains for governments and households altogether, as well as the loss for the rest of the world. And then we're going to take one period where we're just going to give everybody these real wealth transfers. That is the shock. And then we see where the economy goes from there. So we're going to compute the transition path to get impulse responses for individual actions, for aggregates, and for welfare. There's one additional assumption we have to make. As we saw, in any redistribution exercise from inflation, the government will be a big winner. So the responses of the economy are going to depend importantly on what the government does with this windfall. So the assumption here is going to be that it is going to gradually adjust spending towards the steady state. And then the income tax adjusts so as to satisfy the budget constraint. So that's a particular assumption that means that the heterogeneous, the government does not do any sort of targeted transfers to offset any of the redistribution. Okay, so one could think about doing different things, such as changing Social Security so as to compensate retirees. We're not doing any of that here. So those are other interesting things that could be considered. I'm not going to show you that. So there will be then redistribution effects that will follow from this inflation revaluation shock. The question is, are there also going to be aggregate effects? Okay. So here what's going to matter is it that the responses of the winners and losers going to exactly cancel? Or is there, or not, in which case there can be effects on aggregates. So there are two things that will actually lead to aggregate effects in this setup. The first one is that the winners, as we saw, are typically going to be younger than the losers, and they're going to have lower marginal propensity to consume. So that's going to have a negative effect on aggregate consumption. Second, a lot of the losers from my shock can be retired, whereas the winners is working, can adjust labor supply. And so when the wealth effect is going to make these guys work relatively less. So this is going to lower labor supply and output. And so those are the two effects where winners and losers responses do not cancel. It's going to lead to moderate aggregate effects, but they're going to be quite persistent because they're propagated through the wealth distribution. Okay, so they come from sort of wealth effects. Okay, so here's the numbers. This is again the distribution shock that goes in, basically from the old rich to the young middle class, and these are the aggregate effects. So the shock occurs at time 0, and then you have a path for consumption and output that drop and then return back to steady state. So it's sort of 1 to 1.5% deviation. So again, moderate responses, but it takes a long time to go back. And then, given that we have the model and we have what happens after the shock, we can calculate welfare by group of people in terms of percentage equivalent consumption for life. Okay, so a typical welfare measure. And this is the outcome, and it's again organized by, on the horizontal axis, the age at the policy announcement, and then this percentage consumption equivalent. And the result is that these are large differences in welfare, bad for the old people, especially the rich ones, and good for the middle class. Okay, so that is the exercise. And so just to summarize, I'm considering here monetary policy as a revaluation shock. Okay? So there's this increase in a higher inflation target. And that leads to large gains for the government and losses for foreigners. And it has large heterogeneous welfare effects. Net borrowers win, especially these middle-aged, middle-class people. And net lenders lose, especially the rich retirees. There are also moderate but persistent changes in aggregates, so a drop in output and consumption, because the responses to this redistribution shock do not cancel. There are some other interesting details in the paper to do with the role of housing, especially if housing is a fixed factor. So if, in this case where construction is kind of hard. Because what happens here is that you're basically giving money to these middle-class people, and then they try to upgrade their housing. Okay? But if the housing stock is fixed, because it's hard to build, then that's not possible. So there's going to be competition for relatively expensive houses. And that's going to help, in turn, the rich people who lost. Okay? So the housing market has this counteracting effect that in part buffers, offsets the redistribution shock. So that's part of what's under the hood in the exercise in the headline numbers that I showed. And that depends, of course, on the fact that how easy it is to build new houses. Okay, so that's basically the experiment. Let me comment on two things that we're not doing in this research. One is that everything here abstracts from movements in real interest rates. Right? So I put an open economy, there's a world interest rate, and that is not affected by my exercise. If we had a closed economy, especially one with nominal rigidities, then movements in real interest rates would be important. And then in addition to the wealth effects that I've exploited here and that I've isolated the effects of, there'd be sort of income and substitution effects that could matter. And my colleague Adrian Auclair has worked on this and has shown that the redistribution is relevant. There's differential effects on different groups of people that can also be found by measuring their positions and their payment streams and so on. Second comment is, we've taken as given that people use the dollar as a unit of account in contracts. If there were frequent episodes as the one I've described, they might no longer want to do that. Or they might also charge the US government more for any bonds that it issues in dollars. Okay? So it's an important question, as we will discuss, about whether these types of policies, what they do is that price stability is related to the choice of the unit of account. So for example, we worked on this, we asked the question, why is there a dominant unit of account in the economy? And our answer is that basically in a world where there's some frictions in contracting, it makes sense for people to coordinate on a unit of account because that minimizes the mismatch of assets and liabilities in credit chains. And that then the optimal unit in that situation is something that co-moves with the assets and income of likely borrowers, and that's relatively stable in value. Okay? So the first feature helps explain why we've seen government debt as the unit of account in contracts, typically through history in periods in which the government became actually an important borrower. Before that, say in the Middle Ages, the government debt was not typically the unit of account. The second takeaway from that is that if the unit of account is not stable in value, people are not going to use it. So if governments do two erratic things, then their unit of account is not going to qualify. And there's an interesting emerging literature now in international finance on the choice of the dollar as a unit of account in international contracts that talks about this in more detail. Okay.
I will present current research with my co-author Till van Wachter at University at UCLA. And what we're going to show is that short-term business cycle fluctuations can have persistent impacts on those who enter the labor market during a recession, and we will show that there are long life consequences both on socioeconomic outcomes and on health. And this is based on 2 current papers. One just came out in the Journal of Labor Economics, and the other one is about to be completed as a working paper. And what those papers have in common is that we use a methodology that allows us to harness the power of large cross-sectional data sources, such as the CPS, the census, the vital statistics. And we can analyze a long time period spanning over 4 decades. So the idea of this conference is to look at how different households fare over the business cycle. And what we are thinking about is that even though business cycles are temporary in their nature, they might have potential long-term impacts on those who enter the labor market, because this is like a transitional period that might make people particularly vulnerable to these business cycle fluctuations. And there has been a lot of research on focusing on the labor market entry of college graduates, and Abby has some really interesting research on that too. And what this research has shown is that college graduates who enter the labor market during a recession suffer strong and persistent earnings and employment losses that last up to 10 to 15 years. However, much less is known about those with less education or with less than a college education. And this is not to say that the literature is not worried about those less educated people. In particular, it is known that high school graduates have a less structured transition from education into the labor market, and it's a long-standing question whether this increased vulnerability leads to negative long-term effects. So I want to talk about 3 main contributions of our research today. First, we will broaden the analysis of what happens to those who enter the labor market during a recession to those with less education, and we will also broaden the analysis of outcomes. So we will not only look at earnings and employment, but we will also look at things like the receipt of social welfare, which is of course very relevant for the policy debate surrounding the impacts of recessions. Then as a next step, we want to ask whether there are impacts on other outcomes, in particular on health and mortality. And naturally, to answer this question, we have to look at a much broader age period, because the mortality is just so low at younger ages. So we will look up to middle age or up to age 50. And in a third step, we will then use this longer time period to look at effects on socioeconomic status and on family formation. Okay, what are our core findings? First, we show that less advantaged and less educated workers suffer at least as strong effects as college graduates on earnings and employment. And the Economist was kind enough to summarize our findings in their figure of the day. So what you see here, do I have a pointer somewhere? Yeah, perfect. So let's first look at the left figure here. What we see is the effect of a 1 percentage point increase in the state unemployment rate in the year of graduation. This is on the y-axis. On the x-axis, we have the years since graduation. So we estimate separate effects for every year since graduation. And this shows that for the overall population, this is like males versus females, we have about a 4% decrease in earnings for every percentage point increase in the unemployment rate. So if you think about a moderate recession, a 3 percentage point increase in the unemployment rate, then these graduates, they face about a 12% loss in earnings. And this effect fades out only over 10 to 15 years after graduation. In the middle, we compare whites and non-whites. It's a little bit difficult to see, but in general, non-whites have stronger effects in terms of earnings losses, but also in terms of all kind of other outcomes that we analyze. And then here on the right, kind of the most important finding is that we see the top line here. This is those with a college degree. For those, we see an initial effect of 2% that then fades out, within already like 10 years, relatively quickly. But then for those with only a high school degree or even less, we see much stronger effects amounting up to like 5% income losses, which then would translate into a 15% income loss for a moderate recession. Okay, so in terms of mortality, when we look at mortality, what we see is we find positive and increasing impacts on mortality after age 35. So let's look at this figure. What we plot here is again the effect of a 1 percentage point increase in the graduation year unemployment rate, but now it's the effect on deaths per 10,000. And on the x-axis here we have age, that we can think of like that like typically the graduation occurs around like age 18, 20, and so this could be we think of also like as years since graduation. And what we see is first there's actually this reverse effect, meaning like the contemporaneous effect of a recession is on mortality is negative. Mortality is lower in recessions. This is just driven by traffic and car accidents, as I will show you later. Then in this middle range from 25 to 35, there's not really any effect, but then after age 35, there is this positive and increasingly strong impact on mortality. Finally, when we look at this extended time period, extended age period, and analyze socioeconomic status and other outcomes, we find that actually negative effects on wages reappear. And they come along with adverse outcomes for family formation and for fertility. So here again we show the effect on log wages of a 1 percentage point increase in the graduation year unemployment rate. On the x-axis we have again age, now ranging not from 20 to like 30, 35, but all the way to 50. And what we see here is the very what's important to note is, of course, as we expand the age period that we want to analyze, we can only look at fewer and fewer cohorts, right? So this is based on fewer cohorts than the economist figure that we just have seen. However, we see that the initial effect is very similar, right? We start like with a 3% income loss that then seems to fade out over 10 to 15 years. However, then it reappears like a permanent, persistent 1% income loss. And one might be really surprised, given that kind of like the common agreement so far has been that these effects seem to fade out. However, I wanted to say that first, as I said, a lot of the existing evidence has focused on college graduates. And then importantly, if you look at those papers by Oriopolis et al., by Lisa Kahn, they often note like a tiny kind of bump at the end of their age window and say, there could be something, but it's not really clear because it's just based on a few cohorts, and we are not really certain whether this is statistically significant or relevant in the long run. And what our findings show that this is actually a robust negative effect. And this is also when we shorten the age window and like look at fewer cohorts, we still find like this very robust negative long-term effect. Okay, let me briefly tell you a little bit about the empirical approach that we use, and that allows us to look at these big cross-sectional data sets over many decades of data. So let's start with the ideal regression. Ideally, we want to regress outcomes, labor market outcomes, or mortality or family formation outcomes on on this term, which is the unemployment rate and the year of graduation and the state of graduation. And we have like, we estimate separate effects for each year of experience or a year of age, depending on the specification. And then, of course, we also want to control for state fixed effects, because states differ systematically or persistently in their unemployment level and also in other outcomes for other reasons than just business cycle fluctuation. And we also include cohort and year fixed effects. So we really just like look at trend deviation within states and look at how those affect all kind of outcomes in the short and the long run. What are problems with this approach or with this ideal regression in cross-sectional data? First, usually we don't know the year and the state of the labor market entry because people don't report that. And of course, in longitudinal data, we could just observe when and where people transition from education into the labor market, but we can't do this retrospectively in the census or in the vital statistics. Another issue is, of course, that the year and state of labor market entry could be endogenous. So let's say high school graduates who face a recession might decide to stay in education longer. Or if you have a local recession, let's say in Minnesota, but you see that conditions are much better in Wisconsin, you might move across state lines. So we have two different approaches depending on the data set we use. So first, in the CPS data, we use what we call the Syrian Approach. Because there we use the years of education that people report to construct the Syrian year of graduation as just like the sum of year of birth plus 6 plus years of education. And then as a state of residence, as a proxy for the state of graduation, we use the state of residence that people report. So if somebody at age 30 says is living in Wisconsin, then we assume that that person also graduated in Wisconsin, the respective years beforehand. What are problems with this approach? First, this state of residence is potentially really poor proxy, in particular at older ages, as people like more and more migrate or have more time to migrate. And then, of course, heterogeneity is not solved, right? We use directly the reported timing of graduation, and this could be endogenous to timing, as well as, of course, the state of residence could also be endogenous to those labor market shocks. So what we do in the census, in the ACS, and the vital statistics mortality data, there we use, we exploit that we have information on people's state of birth. And what we're doing is that we divide the entire population into cohorts defined by their state and by the year of birth. And then we create a graduation year unemployment rate that we call the double-weighted average graduation year unemployment rate, which uses migration rates and educational attainment rates that are specific to the state and to the cohort as weights to construct this average rate. So for example, let's say that the 1960 Minnesotan birth cohort, let's just assume 50% of that cohort gets 18 years of education, 50% gets 20 years of education, and let's also assume that half of the cohort migrates to Wisconsin before graduation, before completion of education. In this case, we would just take the average of the unemployment rate in Minnesota in 78 and in 80, and in Wisconsin in 78 and in 80. So every unemployment rate would get like a quarter, 1 quarter weight. And this will then be our, what we call the double-weighted unemployment rate. And then we just regress these our outcomes on the on this double-weighted unemployment rate, controlling again for the set of fixed effects, which now of course is like the state of birth and the year of birth. And so this is useful for because first we have solved the This allows us to solve the measurement issue. In particular, in the vital statistics, we don't know education. So in some years it's reported, but in general, reporting is quite bad when people are already dead, and it's often just like not even noted at all. And we can link the educational attainment just through their state and year of birth. The other good thing, advantage, is that this issue solves, or this approach solves, endogeneity issue, because what's important is that for the migration rates, we don't take a particular cohort or state and year of birth cohort's migration rate, but we just take the average trend or the average propensity in a state across many cohorts to migrate. So let's say if we have one particular birth cohort in Minnesota where a lot of people migrate to Wisconsin, we won't use that information, but we just use the average migration rates from Wisconsin from Minnesota to Wisconsin. And the same for the education. So we don't take one particular cohort's education attainment, but we estimate the average or the predicted education attainment based on the state fixed effects and cohort fixed effects. So if one state in general, people tend to have more education, and if education in general increases nationwide over time, then this will be caught in our measure, but nothing that just occurs at one particular cohort, one particular business cycle shock will not be contaminating our measure. So what this also allows us to do is that we can use this kind of like clean measure and compare in the census and in the ACS this double-weighted clean measure to the Syrian approach that we are using in the CPS. And what we are seeing here, or what we find there, is actually that this Syrian approach is doing quite well. So this again shows the effects on log earnings over like 10 to 15 years after graduation. And the red line here is the Syrian approach. You remember again, there we use the self-reported year of graduation, and we use the current state of residence, right? So at, let's say, age 31 or 13 years after graduation, this could be really a poor proxy, right, where people actually graduated. Then the blue line here just replicates the same the same specification in the census data, and the green line then, this shows the double-weighted unemployment rate, which again is clean of measurement error, and it's not subject to endogeneity concerns. So given that all of those effects look very similar, we are confident that the Syrian approach in the CPS data is actually giving us valid insights into the outcomes and effects that we can measure in that data. So let's look at a few more results there. This figure shows the effect on earnings on household income by different years of education, educational attainment. So the red line, that's what we saw in the economist figure, so stronger effects for less educated individuals. The blue line here, that's household income. And what we see there is that some of those negative effects are buffered through household income. And that's both because maybe the spouse isn't as affected as the individual, or of course because people stay with their parents, right? So this is kind of like a buffering mechanism, even though it's not clear how much of a good long-term mechanism that is, because you might be kicked out of your parents' basement eventually, or you might be kicked out of your own house if you get divorced, which could also be linked to those adverse labor market outcomes. Another way that these negative effects are buffered, and I think this is kind of like a nice and a positive result, is that we see strong impacts on welfare receipts, so Medicaid and food stamps, for those with less educational attainment, right? So particular for high school dropouts, you see strong increases in Medicaid and food stamps. even though, of course, as we should expect, there's really nothing going on for those with some college education or with 16 or more years of education. However, even though there are these buffering mechanisms, they are not sufficient to curb poverty. We still see persistent effects, quite strong effects, up to 1 percentage point increase in poverty rates that only fade within 10 to 15 years. And of course, again, for those with sufficient education, there is no effect on poverty at all, even though we did see initial impacts on wages. So overall, what the CPS analysis there shows is that those who are more vulnerable, who have less education, they have anything more affected. There's the social security system buffers some of that, but not sufficiently to prevent increasing poverty rates. Okay, let's look at a few more mortality results now. Again, this is a specification, the same as in the CPS, but now we use the double-weighted unemployment graduation year. It's a graduation year unemployment rate. And instead of years since graduation, we have just simply effects estimated by age. And I showed you already the effects on overall mortality. So now let's split it up by different causes. So on the left hand, you see the effects on disease-related deaths. So there's no negative initial effect here. It's really just like flat. But then we see that the positive effect after age 35 is entirely driven by those disease-related causes. And if you then look at what are the sub-causes driving this effect, we see strong impacts on heart diseases, on lung cancer, and on liver diseases. So these are all causes that can be linked to health behaviors, right, such as like drinking, exercising, nutrition, smoking, which is interesting. And external causes, on the other hand, we have it's driving this negative effect at the beginning, but then it seems to be relatively flat. And there, if we zoom in on different external causes, we see that it's really all just driven by accidents, right? So whenever you hear recessions are good for your health, it's mainly because you're less likely to being killed on the highway, right? Which is not really anything to do with your health, but just like with decreased traffic and in particular like fewer trucks driving around. Interestingly, we don't find anything on suicides. One could have expected maybe increased suicides, but there seems to be quite some resilience, and that it just like not seems to be driven by economic malaise in a way. However, there is an external cause that didn't really show up in this overall figure here, which is drug poisoning. And this, of course, a lot of this is driven by the opioid epidemic. And then this figure here summarizes, there we sum up what can be labeled, or what McKay and Angus Deaton famously label of the deaths of despair, including drug poisoning, suicide, we don't find an effect, but also liver disease and liver diseases, and also we include also smoking. And there we see the strong positive effect, up to a quarter of a death. So that's up to a quarter of the overall effect that we see. And that's quite interesting because there has been this long, like very highly publicized debate about these deaths of despair, and the idea that a lot of the increases in middle-aged mortality that we are observing at the moment could be driven by economic despair, right? This is the hypothesis of McKay and Angus Deaton. However, there's a whole range of papers that have tried to link those deaths to socioeconomic conditions. For example, to unemployment rate at the local level, to lagged unemployment rates, and none of those papers find any relationships. So what's already been asked, like, if it's despair, why don't we see anything? And I think it's interesting if we actually zoom in on the parts of society that suffer most and most persistently from economic fluctuations, then we see exactly that those kind of deaths are increasing. Okay, so if we then extended, we use this extended age period to look at additional socioeconomic and and family formation outcomes. And I've shown you already enough figures, so let me just summarize what we find there. We have already seen the effect, the long-term effect on earnings. So there we had an initial effect of about 3%. The long-term effect is 1%. We see that people earn less. We see that people actually work more. So labor force participation is, if anything, increased. So initially it's decreased, right, if you get it in a recession. In the longer term, and that's particularly driven by women, right, they are more likely to be in the labor market. People are also less likely to be married and more likely to be divorced. And they are more likely to be childless, with like similarly, effects that have like similar magnitudes in percent. And finally, we saw the strong increase in welfare support. But what happens in midlife is that people actually receive less welfare support, which could be linked to the fact, that they're living alone, they don't have children, and maybe they're like, they fall a little bit through the cracks of the system because they don't qualify for those benefits anymore. Nevertheless, they seem to, be suffering, and in particular, not due to kind of like individual level laziness or poor life choices, but really due to just like macroeconomic conditions, which is essentially meaning, that is a cohort that was unlucky around graduation, and we see these really persistent long-term effects. Okay, so let me just summarize what are the main takeaways. First, we see that these negative effects of graduating a recession are, if anything, stronger for the less advantaged groups, and they are only partly offset by welfare benefits. Second, we show that health and even mortality is impacted after age 35 with an increasing positive effect that we see going up to age 50 and very likely also beyond that time. And this comes along with a broad deterioration of labor market and family outcomes. And so overall what this shows is that temporary economic fluctuations have the potential to persistently shift the life course and life trajectories and labor market outcomes of those who enter the labor market in a recession. Thank you very much.
I'm thrilled to participate virtually. I had some teaching obligations which prohibited my coming in person. And this represents joint work with Hilary Hoynes and Alisdair Kuka. And it's published work mostly. So I'll start off with a little motivation. Over the past 2 decades, we've radically changed our safety net for low-income families with children, or at least the cash part of this. So in the background, Medicaid has expanded, et cetera. CHIP has been created, so there's a lot more health care for low-income families with kids. But in terms of the cash assistance program, the welfare reforms of the mid and early 90s have led to historic lows in cash welfare caseloads. TANF is not really much of a program anymore in terms of providing cash assistance to families. It's more of a block grant funding scheme. At the same time, SNAP has become more generous in terms of some of the asset requirements, and states have engaged in increased outreach. But the really big expansion has been the earned income tax credit. So about 20% of tax filers now receive this credit, and it's conditioned on work. So if you were thinking about this low income population, in-work aid has largely replaced out-of-work aid, okay? So given this, my co-authors and I were interested in how the AITC performs as a safety net. Whether the welfare reform and other programs have changed, how they respond to shocks, and what has happened to poverty. There's a large body of evidence that the AITC has very good impacts on kids in a lot of ways, but not much of this research has thought about how it responds to shocks, okay? So the Great Recession provides a good setting for testing the new safety net, and this published work has been in Jolie, JHR, and JPAM. So to start off with what we find for the earned income tax credit, we're going to take a period where the EITC was relatively fixed and exploit differences in the timing and severity of cycles across states as measured by either the unemployment rate or the employment to population ratio. And in thinking about the EITC, even more so than other safety net programs, it's not well measured in most surveys. In fact, what's on the records for the CPS ASEC is their modeling of what people's EITC take-up would be. Instead of that, we're going to take the administrative micro-level data on tax returns that's publicly available in the statistics of income, and we're going to aggregate that to the state and year level by filing type. And just to give you a preview of the results, we find that the Earned Income Tax Credit is providing some countercyclical protection for married couples with children, and is weakly pro-cyclical for single filers with children, but not significantly so. So rather than providing more protection for single families, it's actually providing a little bit of protection for married couple families. And then we compare, using these administrative data, compare it to food stamps, TANF, and UI, and we find that the EITC caseloads are the least responsive to the business cycle. When thinking about poverty, we compare poverty using private income with something that goes partway to the new supplemental poverty measure, a measure of poverty uses after tax and transfer income and incorporates in-kind where it's possible for children, and look at how these two, so compare these two measures of income to the regular poverty thresholds in the official poverty rate, and see how these are affected by shocks in the Great Recession. And the safety net is providing protection, so private income is always more cyclical, this measure of private income poverty. Extreme poverty is more cyclical than just the poverty ratio, so extreme poverty is being under 50% of poverty, and this holds as you go further up the distribution. And things are the most cyclical, or people are have higher rates of poverty more in response to these shocks in single-parent families, households with Hispanic heads, and households with immigrants heads or spouses, okay? And so there's the new supplemental poverty measure tries to do a much better job. Everybody in the room probably is familiar with some of the weaknesses of the official poverty measure. And then we also consider an OECD more relative measure. And this doesn't seem to matter very much for poverty or higher multiples of the poverty rate, but it matters some for extreme poverty. And how you treat valuing Medicaid and other kinds of health insurance doesn't really make much of a difference here at all, okay? So this graph shows you, in the blue line, AFDC TANF cash grants per capita, and the black squares are EITC total expenditures per capita. And the vertical black line is the federal welfare reform in 1996. So you can see here that the cash grants per capita have fallen off to a very low level, while EITC total expenditures per capita have increased greatly. And as I said, about 20% of households are now getting EITC, okay? This tells you for year 2010 for families with children, something about the magnitude and number of recipients and average monthly benefits from these different flows, okay? So 2010, these numbers would obviously look different today, but in 2010, TANF is down to about 2 million families. The federal EITC, by contrast, is touching nearly 26 million recipients. SSI is important. SSDI is just listed there to be complete, okay? So, as I said, the Earned Income Tax Credit is this refundable tax credit for low-income families. You need to have earned income. The credit varies by the number of children and by your level of earnings. And there were expansions in '86 and 1990, and particularly a very large expansion in 1993, which is when they created the version for the childless families too. And it's a quite large amount of the credit. So in tax year 2009, the average credit was nearly $2,200, okay? Food stamps currently is EBT benefits that you can use to buy unprepared foods. It's the only universal part of our safety net now. You need to have gross income under 130% of poverty, unless you're in a state that's implemented what's known as broad-based categorical eligibility, and your net income has to be under 100% of poverty. And then TANF, the former AFDC program was an entitlement, but TANF, I think, is more properly seen as a funding stream. So some states, for example, my home state of California, provide limited cash benefits for low-income families, but much of the TANF funding stream has been repurposed by states for other uses, okay? And it's fixed in nominal terms at the level when they passed PRORA, so it has shrunk by about a third since then. So what do we think a safety net should do? We think it should increase resources at the bottom of the distribution and reduce poverty or reduce poverty gaps. It should provide protection in times of economic need, and it should be a counter-cyclical benefit, okay? So this chart shows child poverty rates for 2011, and in a static sense, it shows reductions in the poverty rate from safety net income using the supplemental poverty measure. So this does not incorporate any behavioral characteristics, but it gives you a sense of, you know, if you take people and you take away the income of this particular type, what would be the change in the poverty rate? Okay, so what you can see here is if you took families that are getting the ITC and as imputed by the Census Bureau and you took it away, if you look at their poverty rate without the ITC and you add the ITC, the poverty rate goes down by 6 percentage points, okay? You see SNAP is doing a lot in this area, and then if you go over to the right, you can see that TANF is doing very little, okay? So the reason that the ITC does so much in part is because the largest amount of the benefits are coming to people who are near the poverty threshold, so it's moving a lot of people across the threshold, okay? So EITC in this sense is very important, TANF is minimal, and SNAP is also important, okay? So what about whether the EITC is providing protection in times of economic need? At the time we wrote this paper, as far as we knew, no one else had actually looked at this for the ITC, and we didn't know much about it for TANF either, okay? Now, I just should point out, income insurance is not an explicit goal of the ITC. The goal was to increase income at the lower end of the income distribution while encouraging work, and the program clearly does this, but it seems important in an era of less welfare and more in-work tax credits to think about whether the ITC can be responsive. So previously, SNAP did this, and TANF did this, and we also thought it was interesting to know what happened during the Great Recession. Finally, you know, we compare it to the role of unemployment insurance because, you know, while unemployment insurance is a social insurance program, big parts of the funding in bad times are completely free to the states, and it sort of is functioning more as a safety net program in our view. Okay? So the data we're going to use for this are statistics of income microdata. So this is a representative sample of all tax filers, and it's administrative data. Okay? And the data contain information on your filing status and number of dependents, earned income, the amount of EITC credit you got, the number of children that you qualified for with the EITC, and state of residence, except for some very high income filers. And so we dumped them because we didn't know where they lived. And then we had to, people that are married but file separately are ineligible for the EITC. And we also didn't use filers from the territories or living abroad. So then we collapsed these data based on year, state, and marital or filing status and number of children. And so there are weights provided with this. So we can figure out for these cells the number of filers, the number of filers claiming the EITC, and the total number of EITC dollars claimed, okay? So what do we think should happen with the EITC? This chart here is showing you earned income along the x-axis and the credit amount in 2012 along the y-axis, okay? So if there's a labor market downturn, we expect people's employment to go down and their earned income to go down. So if you were in the range here where you would be ineligible for the ITC in the absence of the shock, and you are driven down to a point where you're eligible for it, then that group's participation in the ITC could go up when times are bad. You know, whereas if you're in a range more like here, you could leave the entire eligibility range by losing your job if it happened at the right time, okay? So these charts show you for these different groups, so singles with one child, singles with 2 or more children, because the credit is much more generous for those with 2 or more children, married and married with 2 or more children. And this is, these are histograms for all tax filers, not for people on the EITC, but for all tax filers. And they have the EITC credit schedule is the dashed lines, okay? And so the point of this graph is that the married people are much more likely to be in the range where they're ineligible for the EITC, but with a shock, they could fall into the eligibility range, whereas the single filers are much likelier to be near to the area where they might fall out of eligibility altogether. So what are the predictions then? We think single parents would have a higher risk of losing EITC eligibility because they have a higher risk of their earnings falling to 0. And married couples might increase their EITC eligibility. So this led us to expect that caseloads for the married couples would be more countercyclical than caseloads for the single parents, okay? So the model is pretty simple. It's a 2-way fixed effect model. The business cycle is measured by the state by year unemployment rate, but we also looked at employment to population ratios. And our outcomes are going to be caseloads, dollars, and filers. And we need a version of the at-risk population for the denominator. So we created from the CPS counts of people in these groups. So for example, for singles with children, the numerator would be something like the EITC, the number of returns claiming the EITC amongst singles with children, and the denominator would be an estimate of the number of singles with children from the CPS. We chose a period from 1996 to 2008 so that the EITC schedule is relatively stable, okay? So what you can see here is these are the max benefits, the max credit for these different groups, and you can see it's flat for the period that we're looking at. We also had to stop in 2008 at the time because that's when the SOI data were available. So this shows the results of some different regressions. And what you can see here, each column is a separate regression. The first column pools everyone, and then we split it out into people, filers with kids who are married, filers with kids who are single, and filers with no kids. And you can see here this result that we expected to see. If you're a married filer, then when the unemployment rate goes up by 1 percentage point, you see about a 6% increase in the number of filers with EITC benefits. And it's an insignificant 1% decrease for singles with children. We can also look at the number of filers, and we see the total number of filers, fewer people, singles and with no kids, are filing when times are bad, perhaps because likely because their income is too low to make it make sense for them, and there are a lot of credits they're missing. And then if we look at filers who are in the eligible region for the ITC, we see a strong increase in filing amongst married folks with kids. So this is consistent with this idea that the shock is leading some of these married filers with kids to move into the eligibility region and, not changing things very much, or at least not in a significant fashion for the singles with children. So this graph is splitting this out by looking at the number of filers in the various ranges, okay? And you see an increase in the number of married filers with children in the phase-out range. This is the analogous graph for singles with children, and you see not much going on here, maybe an increase in those in the phase-in range, and then I had already showed you what the extensive margin was for this. Okay, so the next thing that we did was look at how the cyclicality of the EITC compares to other programs, other safety net programs, And this is all using administrative caseload data. So I would tell you not to focus on this, but think about the EITC amongst families with kids, because these other groups were more interested in how they are providing buffering for families with children in this research agenda. So AFDC TANF is, this is primarily driven by the TANF part of this. If we split it out into AFDC and TANF, AFDC is countercyclical, TANF is not countercyclical, and then you see food stamps and UI are much more countercyclical than the EITC is. So then we also considered how cyclicality of poverty is affected by the EITC by looking at various cuts of official poverty with and without the imputed maximum EITC from TaxSim, and found that in this static sense, the EITC is reducing the cyclicality of poverty as well for married couples with children, but there's little or no effect for singles with children. So again, the EITC has other great characteristics, including increasing work and actually improving kids' test scores and improving health, but it is not a good countercyclical program because of the way it is designed. So I'm going to skip this one. The second thing that we did as part of this agenda is to sort of see in a paper in Jolie how the cyclicality of these programs has changed after welfare reform using administrative data. Okay, so we used a very similar two-way fixed effects model, with the difference being that the effect of the unemployment rate was allowed to vary with, were you close to the big recession of the early 1980s? Were you in the Great Recession period, or were you in the rest of the period? Okay, and while AFDC, TANF together, AFDC was countercyclical in the period of the bad recession of the early 1980s, or two recessions, but we pooled them together for this purpose. Food stamps and UI are the same during the Great Recession, or perhaps even more countercyclical, but TANF is no longer providing this countercyclical consumption smoothing through more people being on the caseload. The thing that's nice is that we can add up these administrative dollars and get a sense of all of these parts of the safety net put together. And the safety net is still countercyclical as put together in the Great Recession period, but the point estimate is a little bit smaller than in previous periods. So I think I might have gone a little bit faster than expected. It's a little hard to do this from here because I can't see everybody as well. But the conclusion that we have from this work, since the late 1990s, we know we've had this big shift from out-of-work aid to in-work aid in the safety net, and there's a lot of discussion about doing more of this. The EITC is the largest of these in-work programs, and it plays a very important role in reducing poverty, as well as having all of these other positive effects at a particular point in time. When we've looked at whether the EITC also does a good job of being an automatic stabilizer, we find that it is not doing this well for single parents with children, but it is for married couples with children. This is clearly what you would expect from the program design, so it shouldn't be a surprise, but thinking that it can replace the kind of stabilization that TANF used to provide for these kinds of families would be somewhat misguided. Okay, the ITC is also less cyclical than other programs, and then the other key takeaway from this research, we think, is that the TANF program is not providing this countercyclical smoothing that the AFDC program used to provide, and that's not surprising given that TANF is primarily a block grant to states and no longer an entitlement program.
So we're going to take some questions. I was going to ask the first question. I had one question for every presenter. And so I guess in terms of the first two papers, we're directly talking about monetary policy to some extent. And I would say both of your papers sort of raised a little bit of a challenge to conventional wisdom on monetary policy. So Alisdair, I mean, the challenge for you is like the conventional way we talked about monetary policy is that policy acts with long lags, and so we got to get ahead of the curve and start providing stimulus at the first sign we see trouble in the economy. And your model seems to suggest maybe that's wrong. Maybe we should hold off. So so looking forward, I mean, suppose we do start to see at some point, I guess we're going to start to see some trouble, signs of trouble ahead. What is the optimal time to start providing stimulus? Or thinking differently, instead of thinking forwards, thinking back to the last recession. If we learn something from your model now, if we'd known that at the time of the Great Recession, might we have responded differently there? Would we have done something a little different? So I think you can think about that for 1 second, and then I was going to just, and then I'll say the question I was going to ask to Martin was, I guess that piece of conventional wisdom that I see your paper is challenging a little bit was this view. The conventional view was that sort of, we care about distributional issues. Everybody cares about those, but as a central bank, we don't have very many instruments, and the conventional view is the blunt instruments that we have, we can't really do that much about distributional issues. But your paper seems to suggest that actually changes in the inflation rate can have very large distributional consequences across different groups. And obviously, we think of ourselves as having at least some kind of measure of control over inflation rates. So if you think about the US, say, going into a recession, and the Fed trying to fight inflation, it seems like your model poses a little bit of a quandary, because on the one hand, a little bit more inflation might redistribute in a way the Fed would like, from the old rich to the poorer middle class. On the other hand, it looked like in your model that would actually be contractionary too, because these agents have different propensities to spend. So anyway, that was a little bit of the. So maybe I'll just start with those two questions. Maybe Alisdair, and then I had two questions on the two empirical papers. But
sure, that's a good observation that you made. So when we look at empirical responses of the economy to monetary shocks, we often see these sort of hump-shaped dynamics, we call them. And the model that I was discussing doesn't really generate those hump shapes. It's quite difficult, actually, to generate those hump shapes. And the way macroeconomists sometimes engineer those in the models is with higher order adjustment costs and habits. But in terms of the micro level details of what's going on in the economy, it's a little bit hard to make sense of those higher order adjustment costs. So I sort of think there is a gap in our understanding of how do we connect this sort of lumpiness at the microeconomic level with these sort of hump-shaped dynamics in the aggregate data. I think sort of imperfect attention might well be a part of the story. That's something that we hope to flesh out going forward in this research agenda. But you're right that it sort of interacts with the this idea of, do you want to get ahead of the game or not? But I'll make the point that the qualitatively, the argument that I was making goes through in a model with hump-shaped dynamics with higher order adjustment costs. But it plays out longer in the future. So this sort of reversal of wanting to get ahead of the game, for what I was discussing here, it happens very quickly. But in that sort of richer model, is a couple years down the road that you would worry about this.
thanks, Alisdair. Martin.
So I mean, I think that the study of these nominal positions and more generally fixed income positions shows that any movements in interest rates will have redistribution effects. And it's worthwhile taking this into account. For thinking about business cycle responses, it's sort of just interesting to combine any kind of interest rate movement with other policy responses, because, I mean, as I showed, there will always be a large government position that gets affected. And so what I showed is this example where this all just goes to government spending and not to transfers. And so I think for say, a stabilizing response, one would want to investigate things like if there is a change, say, in inflation that increases government wealth by lowering government debt, then this could be used, for example, to increase transfers. and which would be another thing that helps stabilize in the context of a recession. And so that's something that so some of the calculations that we've done that in this direction show that it's relatively easy to create a coalition of, like a large coalition of people that would favor inflation, because it's relatively cheap to offset the negative effects on many retired people through transfers that can be funded by the fact that government debt is now less. And so that, I think, is for the stabilizing policy, that's sort of the type of consideration what we want to put.
Thank you very much. So, and then on the two empirical papers, which were not, I thought both of them actually very interesting, and I learned a lot from them both. Not so directly related to monetary policy, but I had two kind of fairly specific questions on both papers. So on the first paper, I guess on Hannah's paper, I was a little unsure exactly the story you were telling about these long-run persistent effects. So I guess there are two possible channels you could say. So one is that even the labor market effects on employment and wages are very, very persistent, and it's persistent negative labor market effects that translate later in life to persistent bad health outcomes and mortality and other consequences. Or perhaps the other story is that it's not so much that, it's just that if you enter during a recession, you spend a bunch of years when you're either unemployed or taking low-wage jobs. That's a time of life when if you're not working, you do bad things, you pick up bad habits. Maybe you're less likely to get married, more likely to start smoking. And it's those choices, even if later in life you actually bounce back and you do get a job and you catch up, and some of your graphs seem to show there was, you more or less catch up in terms of labor market outcomes, the scarring and those health outcomes is from the earlier period, and that hangs around. So that was my question for Hannah. And then my question, I guess, for Marianne was, we looked a little bit in independent work with Fabrizio Peri and Gianluca Violante. We've looked a little bit at how various government safety nets and through taxes and through transfers affect the dynamics of inequality in household disposable income and consumption over recessions. And we found generally that these various programs, through both a mix of taxes and transfers, they do seem to provide quite an effective safety net, in the sense that when you look at inequality in disposable income, at different measures of that, you don't see a big spike in income inequality in big recessions. And we found that was actually the case even in the Great Recession. Looking at more recent data, this was data from the CPS, that you see, and if you look at inequality in, say, labor earnings or wages, you see a huge spike in inequality as the economy goes through the Great Recession. But once you add in all the various transfers and subtract taxes, measures of inequality look much smoother. There's kind of a bit of a long-run upward trend, but you don't see a spike during the recession. So I was just wondering if you had, you're looking at different data than we're looking at, but if you had found something similar or something a little bit different than that. Thank you.
Yeah, thank you for the question. So regarding whether these long-term health effects, are they caused by the long-term or persistent effects on labor market outcomes, or is it more like this initial stronger impact, what you said, like leads people to pick up bad health behaviors, maybe not getting married and so on. So this is clearly what we are most interested in as next steps to analyze that more. Even though I think a lot speaks already to the idea that it could be these persistent economic outcomes. I mean, first, like the 1% permanent income increase, it's quite sizable compared to the 3% initial, right? Especially if we're talking about like 5 years versus permanent income effects. And the second thing is, it's actually not really the case that people get less married, and it's kind of like a poor bad choice, a life choice. It seems the other way around. Actually, recession graduates have much higher marriage rates right after at the beginning of their careers, probably because they have like lower opportunity costs. And that doesn't seem to be a particularly good idea, both in career terms, but also because we see a lot of those marriages then dissolving later on, right? So then you have like the double negative. You have your, you're not on a good career trajectory, and your private life is in shatters. So that's negative. And I think one important takeaway overall is that when we look at those social policy responses, or like the social net, is that it's great to see that you know, there are these buffers, and that Medicaid and SNAP and those programs are targeted and responsive to those people. But it really seems that this is more the period where we are aware of that there's a problem, right? And the long-term effects, the long-term economic decline, this is not something that is on policymakers' radar yet, right? And then we are surprised about why is there increased mortality in midlife, and why are there suddenly groups of society that are marginalized? And we are wondering, is this people's choices, this preferences, what's going on? But part of this could be these persistent, you know, business cycle fluctuations, which we traditionally want to buffer with those programs, and we do buffer them in the short term successfully. But maybe we have to kind of like broaden our horizon there, and keep those people on the radar, and you know, support them more and more persistently, like those very specific, most vulnerable parts of society. Thank you.
Thank you. Marianne.
So yes, in the JPAM paper, we looked at exactly this question you're asking. So I know I covered a lot of stuff quickly, but in that paper, we compared the ratio of private income to the poverty thresholds, and how that responded to the unemployment rate, to what happened when we added in all the parts of the safety net that we could add from the CPS that are produced for the supplemental poverty measure. And at every poverty level under 200%, private income was much more cyclical than after tax and transfer income was. So I think what we're finding is something similar. And then, as I mentioned, if we sum up all of these cash and near cash in the case of SNAP flows, and looked at how that responded to the unemployment rate, it was quite counter-cyclical even in the Great Recession period. However, I would make one additional point, and this is also relevant to something Hannes said. You know, Medicaid, while it is part of the safety net, is not something you can consume if you need it right away. You know, it provides medical care. It doesn't, you can't use it to pay your rent. You can't use it to buy food. You can't use it for other stuff. So I think, you know, while the results I talked about are not very sensitive to how you treat either Medicaid or other public health insurance or premiums, I think medical care is kind of a different good in terms of thinking about people's disposable income.
Great, thank you. So please, we should open it up for questions, and maybe start with Abigail.
So I just wanted to follow up on Jonathan's very nice questions, and I think pose a question that maybe tries to pull together the four talks that we heard and ask, you know, just anyone or all to weigh in on them. So I think that a common thread running through what we heard in this panel is the disparity in experiences between different groups over the course of business cycle fluctuation. So in Hannes's case, this is between recession graduates and non-recession graduates. And in Marianne's case, this is between those who are in work and out of work. And then we also heard from Martin about borrowing households versus lending households. And Alisdair's is a little more complicated because it's sort of between us today and us tomorrow. But once we have this information that different groups experience these downturns differently, it then is clear that potentially we have some efficiency to gain by targeting any interventions that we might do towards those groups who are experiencing the downturn more severely. So I'm going to ask you to sort of wave your wand and say, what kind of tweaks in responses would you like to see in the next downturn? Maybe Martin could start because he began sketching that out in his previous answer, but I think anyone is willing to weigh in, and those might be tweaks on the monetary policy side, but they might also be tweaks elsewhere in the policy arena.
I'm happy to weigh in. I think something that it would be good to have us move towards is the ITC has great effects, but we have gotten rid of payments we used to make to families with children who didn't have parents who worked. And I would like to see us add some sort of a child allowance so that children could get benefits even in the absence of their parents working. I don't think aid for children should be conditioned on their parents working. And Marianne Page and I had an article in Russell Sage Journal sort of suggesting that you could pay for around a transfer of $2,000 a child by repurposing some of the ITC money, or pretty cheaply in other ways by repurposing, this was before the new tax law was passed, by repurposing deductions, exemptions, and the child tax credit.
Yes, please, Martin.
Okay. All right. So, yeah. So, I mean, one thing that, especially in the Great Recession, where there was a situation where lots of people, there was a shock, and lots of people got into trouble because of the debt they had. Then the question that comes up is, lenders and borrowers made a contract together. The contract didn't work so well. Who should be, if there's transfers, who should they go to? And there is a tendency in recent history to focus that attention more on lenders, as in bank bailouts, as in going outside of the US to the European crisis, to lenders in my country, Germany, as opposed to Greeks. And in models in which there are financial frictions, where borrowers are constrained when they get into trouble, there can be an argument that maybe there should be more targeted transfers towards borrowers. And so our calculation suggests that, say, inflation is something that would do that. Yeah. So that, I think, is inflation in a setting with a nominal credit market, inflation can be a tool, a blunt one, but it is a tool of redistributing towards borrowers and thereby perhaps offsetting shocks that have hit borrowers in particular.
Yeah, I think one important takeaway also is that we just need to inform society and the public about what we find, because we study business cycle consequences for years, and do all these difficult data analysis and empirical methods and models, and then we know, oh, these are the losers and these are the winners, but we kind of assume that people themselves know that, which is of course not the case, right? And for example, I mean, this might be very important, I think, both for the perception, but also then the way how people treat these personal crises, right? If somebody tells you lost a lot of wealth or income just because of those macro shocks, rather than you did really poor, financial choices, or let's say you have a bad job not because you're much worse than your older brother, but maybe because you got it in a worse year, right? Your response might be very different to that. And you might be much more likely to get out there and try to improve your situation than if you just think, well, I'm maybe not as qualified, I'm not as good, and I don't deserve a better job. And I think that's something that I sometimes realize, when I talk to people, that of course, I mean, we are the experts figuring these things out, and that's not something that people will know. Plus, at the individual level, there's always a lot of noise. So, they might even have good reasons to believe that they deserve the situation they're in.
So in terms of my project, the research points in sort of a direction that we should continue to think about, which is that if there's a role of intertemporal shifting of demand following monetary stimulus, then you want to think about when is the best time to use it, which is quite different from that textbook model that I explained. But then, in some sense, my presentation focused on the cost of stimulating early. There's the other side of the coin, which we really didn't speak to. Presumably, you're going to do the stimulus earlier in response to some other development. And so a careful balancing of those costs and benefits is something that we haven't done yet.
So I have a question for Alisdair and a question for Marianne. So I'll start with Alisdair. So speaking of kind of going both ways, I was wondering how symmetric the implications are of thinking about these lumpy durables in terms of tightening. So is kind of is there a symmetric implication in the sense that this is a good explanation for why it's much easier for the Fed to put on the brakes in the economy than kind of stimulate? And also kind of related to that, what's the role of depreciation in thinking about the durables in all this? And for Marianne, the question I had was, how do we think about the interaction between unemployment insurance benefits and EITC? Because since EITC has drawn more people into work, that means during a downturn, they're going to be more likely to be eligible for UI benefits. So maybe some of the cyclicality that's lost by moving to EITC is somehow picked up, maybe not necessarily as much for those that aren't working with children, but for at least some subgroup picked up by UI benefits. And I was wondering if you guys looked at that interaction at all over the cycle.
Okay, so great question. So yes, first there is empirical evidence that monetary policy seems to be more powerful in expansions than in recessions. And that's very consistent with the sort of view of the world that I was putting forward. And a sort of good sort of rule of thumb that you could use from the model is that, in the model, what would dictate the effectiveness of policy is how many people are near that adjustment threshold. And how many people are near the adjustment threshold is very likely closely related to how many people we see making adjustments at a point in time. So if there's a boom when many people are making adjustments, that would indicate that there are many people on the margin and that changes in the incentives would have a big effect. So I do think it would have some symmetric implications. And in terms of the depreciation rate is in some sense what defines a durable good, that it depreciates slowly. And so that's important in a couple of reasons. So one is how long lasting, if we get people to buy goods today, how long are they going to be sticking around is a crucial ingredient. But then also in terms of the power of monetary policy, it's very closely related to this durability in as much as with a low depreciation rate, interest rates or opportunity cost of foregone interest is a big component of the user cost of holding those durables. With a high depreciation rate, the depreciation rate is a key component of the user cost. So the sensitivity of durables to interest rates depends on this depreciation rate.
So
Well, Marianne had.
Marianne.
Meeting.
Yes, please.
Okay. So yes, we looked at summing up UI, AFDC, TANF, food stamps, and the ITC. And as I said, once you include all of those, on average, things are counter-cyclical. I think the challenge is, and an additional piece of work we did was to go to the CPS where we would be using not the grade administrative data to look at EITC take-up, but amongst when you use the CPS, you can look at skill groups, and so the more skilled single parents, it's a little more counter-cyclical for them because they're near this range where they're falling into eligibility, and the low skill groups are falling out. So the low skill groups are likely to be, lower income, not earning that much, and perhaps not getting very high UI benefits. But I think the other thing to remember about, the EITC money isn't coming till next year. So I lose my job now, maybe I get a little more UI now, but then next year, my UI in any kind of normal recession will be gone, or at least close to ending, and my EITC payment will be gone. So next year is when the EITC shock is going to hit me, because you get it the following year after the labor supply has occurred. And so that's another way in which it's not a very responsive program to bad times.
Thank you. I think next. Yes.
This is a question for Alisdair. So I understand in your model how the intertemporal mechanism works through short rates, and then how the implication then goes through that you might want to do the path of rates is really, you get more for your money if you do it now more rather than promise this path. But I think part of the argument with forward guidance was I affect the path of short rates to ultimately affect long rates. So I was wondering how, if the logic of your model would carry through on investments or purchases that are more highly affected by long-term interest rates rather than these short rates.
So there is this view that purchases of these durable goods are affected by long-term interest rates. From the perspective of my work, it's not really clear why that is. So If there are no adjustment costs, you just manipulate your durable stock or capital stock period by period in adjustment to the current short rate. If there are adjustment costs, then you maybe have a longer term perspective. The point of view that we've taken is let's take the form of adjustment costs that we think most closely aligns with the microeconomic decision problems that households face or firms face. There's lumpiness in investment too. And those give rise to this logic that it's actually the short rate that's going to matter more than the long rate. It's still the long rates matter, but the short rates more. So exactly how to think about the premise of your question that long rates matter for certain activities or matter more for certain activities is sort of what we're questioning. And I don't have a good way of thinking about why it should be the way you suggest.
Okay, so Fabrizio next, and then David.
Yes, I have a question for both Hannes and Marianne. So your work is super interesting and shows that there's big shocks coming from recession, and this big shock seems to be only partly insured through these government programs. And I mean, I've worked on that, and I find exactly the same. But I want to ask you, and what do you think about another effect of this insurance, and it's the effect of the behavior? Usually we take the income shock as given and say, okay, how much can insurance? But one important thing is that this insurance program can affect behavior. And I mean, it could be both ways. I mean, one way, for example, could be, well, if I have this pretty generous transfers program, I just say, well, I'm not going to work. And so you see a lot of very large impact on before tax income because people take this benefit. The other possibility could be the opposite. So, well, actually, because I have this generous transfer program, I don't have to take really bad jobs. I can afford to be more choosy, more education. And so we have actually beneficial effects. So I was wondering if you guys have looked at that and what you're thinking about. What's the feedback of this transfer program, not only on the direct insurance, but on the behavior and on the job side, and how the feedback on the impact they have on the future job prospects.
Okay, maybe I can answer first because my answer is probably quite short. So we haven't looked at that yet, and that would definitely be very interesting. At the same time, yeah, I mean that's always the moral hazard component of health insurance, for example. But yeah, I would highly doubt that the long-term effects on mortality that we find are due to these people having more health insurance rather than less. But yeah, that's an interesting point. We should look more into that. Thank you.
Marianne?
So I'm going to not necessarily speak entirely based on my own research, but certainly the old AFDC program had very strong work disincentives, and there's a suggestion. So there's no question about that. We know that it had work disincentive effects. The food stamp program and a lot of these other programs, obviously. Reviews by folks like Robert Moffat and Carl Scholl suggest that their work disincentive effects aren't as bad as the old AFDC program because their disregards are lower, or in the case of the ITC, it's actually increasing work amongst people at the very bottom, and there's a small effect on married couples decreasing their work later on. But in terms of, I think what you're thinking is that the ITC is getting people into work, and then maybe things go a lot better for them afterwards because they get on a better job ladder or something like that. So just based on what we know from claiming of the ITC, and this is not my work, but this is work by Maggie Jones at Census and some other folks, there's a lot of churning from year to year in the ITC actually. So it's not like families are on it and stay on it year after year, which would suggest that they have relatively stable earnings in the range of eligibility. But people tend to cycle in and out of it. So to the extent that you can take any inference from that might answer your question.
Thank you. And David, you had a question, I think.
Also for Marianne. Good morning, Marianne. I'm impressed that you were on the line at 6:15, I think, local time. Your time. It felt early here, 8:15. It's David Wilcox speaking, by the way. We now share being both former employees of the Federal Reserve Board. I may be asking you to reiterate what you said before, but if so, I'd just like to hear it again. The focus of your remarks was how the EITC was not a very effective countercyclical tool, and I wondered if you could just reflect a little more about whether that's intrinsic to the design of the EITC and whether it's just simply the wrong tool as a countercyclical device, or are there ways that it could be redesigned to make it more favorable, to give it more favorable properties as a countercyclical tool? And then secondly, I wondered whether there's any role in your view for trying to boost the extent to which eligible individuals actually claim the EITC.
Thank you, David. I was actually David's RA at the Fed before I went to grad school, so it's great to reconnect in this way. So in terms of restating things, yes, I think it's an intrinsic feature of the design of the earned income tax credit, the federal part of the credit, that it's not going to be that great as a counter-cyclical stabilizer for those at the bottom, because there's this large phase-in range where there's a subsidy to your wages, but so therefore, obviously, the amount of the grant falls a lot, the amount of the credit falls a lot as your earnings decrease, because that's the way it's designed. This is only exacerbated by most states' state add-on EITCs, because they're just usually a % of what the federal credit is. The one state that has a quite different design is California, which is pretty new. So its design comes much closer to being to extending the flat part of the EITC down to a zero earnings level. So it has a sort of slight wage subsidy, but not a very big wage subsidy. So that enables it to be providing more income to people with lower income, lower earnings. Okay, so that has a cost, in that you're no longer subsidizing entry into work as much as you are with the ITC. So to the extent that that's an important component of what you want to have, that would be a cost of this kind of California design. But I think it'll be interesting to see what comes out as the California program is around longer, in terms of understanding, is how well it's doing at reaching these lower earning folks. And then I think the second question was, is there a role in increasing take-up of the EITC? So the EITC has actually got fairly high take-up as far as these programs go, but take-up is lower for groups for whom the credit is smaller, which makes sense. There's been some interesting work recently from Dave Manoli and Bhargava, his co-author in the AER, where they tried a bunch of different things to try to improve take-up of the ITC, and they found that, interestingly, some of the things that they surmised would matter didn't matter so much. This was amongst a group that hadn't taken it up, even though they were eligible for it. So, there is probably some room to increase take-up for people for whom the credit isn't very large, but overall take-up is fairly high.
Hi, Marianne. It's Bill Spriggs. I had a follow-up question to David's. You didn't get to look at the response post-Great Recession, but one of the things the Obama administration did was to boost the EITC. So in your work, that phase-in period where essentially you get penalized because you get pushed down the hill, did you disentangle the effects for single parents to see not that you go out of eligibility because you didn't work, but just look at the share of people who were being pushed down the hill and whether it's conceivable that a correction to the program is during a downturn to do like the Obama administration, just make the benefits bigger, understanding that you're pushing people down the hill. So you're just going to give more money. You've made the hill higher.
So we didn't exactly look at that, but we did look at the change in filers in the various eligibility ranges. And I probably zipped past that slide when I was talking. And my recollection is that there wasn't a really big change in filers within the range of the phase-in, but that's not exactly the question you're asking. And the ideal data for this would actually be panel data, because the SOIs are sort of repeated cross-sections, so then you could follow people and sort of see what happened when they got shocks. But that's not something we can look at with the public use data.
Any last? Morris.
I have a question for Hannes. So you were emphasizing very much these fluctuations over the business cycle for the unemployment rate, but you also mentioned that states have very persistently different unemployment rates. Would you expect that these persistent differences in unemployment rates somehow have different effects, or why do you think that the cyclical effects might have bigger effects in terms of persistence than these persistent original effects across states?
I mean, one reason why I guess the focus is interesting, particularly here, because the theme of the conference are the business cycle fluctuations. At the same time, also, of course, in terms of identifying, causal effects of those environments, this is something, interesting to zoom in on. At the same time, of course, we are measuring something that we think has like a broader relevance, or is more generalizable also to many other phenomena. And this could be just, as you say, living in general in a higher unemployment state, even though, of course, many other things are also different. So it's difficult to really disentangle. And also, if the message that you tell people is just like, oh, you just live in a bad state, then nothing you can do about it. It's maybe also, there's like less of a takeaway there. But I guess like on one broader aspect is that it's just the idea that there can be shocks, or maybe also more permanent shocks, such as like technological change, or maybe social progress that maybe leads to less of an advantage for some groups, while it improves like the disadvantage, or like lowers the disadvantage for other groups. That like all of those changes can have these persistent impacts on groups that are vulnerable to these changes, and even like several decades down the line, where we think, oh, we don't connect these phenomena anymore. We don't think that there should be such a persistence in people's trajectories, because in a kind of a standard baseline model, we would say, well, there's technological change, you lost your job, but 5 years later, you should be in a new job, and it shouldn't matter. And maybe a lot of those issues that we are facing could be long-term effects of more temporary phenomena. And I think this is where our research speaks in particular to.
Thank you. Question in the back. Is it? I can't see. I haven't got my glasses. Is it Darian, maybe?
This is a question for Hannes. I was just wondering whether you had looked at how responsive the choice of how much education to get is to these sort of shocks to the unemployment rate, or sort of similarly, since this is the other dimension of potential selection that you mentioned, how responsive is cross-state mobility to these unemployment shocks?
Yeah, I think in general, what you see throughout the research on like how people respond to shocks, like Abby has like also papers on that, is that there's actually much less responses than we would assume from an econ perspective, and that includes both the timing of graduation. So you can see statistically significant timing responses, but the magnitude is just like very, very small, and that's why we get very similar effects whether we control for that or not. And the same for migration, but this is also a theme that comes up when you look at trade shocks, right? And or just like technological change. You see these declines in certain industries, and then even though there are great job opportunities, in the state next door, people don't go there, and that I think is a general puzzle. And I guess one aspect is that maybe at the individual level, people might not be really aware what is an aggregate shock, what is a temporary aggregate shock, versus what is something that is specific to them, and there might not be a better opportunity for them, just a few hundred miles away.
Maybe one last question, if we have any.
I have a question for Marianne about some of the differences in the EITC recipient groups. I think you talked a lot about the differences between single and married filers. And I was curious, and I apologize if I missed this, if there were any significant differences between families based on the number of children. As we know, families have to make decisions about childcare, and it seems like there might be different ramifications for families with 1 or 2+ groups, as I believe the EITC groups them.
So we looked at them separately, but the differences weren't as stark as you might, they weren't so stark as to be the major focus. The really big difference was the singles versus the single or other measures of being relatively low earning folks were not getting this countercyclical benefit, and the marrieds and groups that have relatively high earnings are getting some countercyclical benefit.
Great. Okay. Well, I would like to thank all 4 of our panelists for 4 great talks.